Good morning, good afternoon, good evening, depending on where you're joining us from, and welcome to the fourth panel on corporate climate engagement and regulation, advancing net zero corporate and commercial financial law and policy. My name is Keisha Varvind. Kayla Hollingsworth and I will be your Zoom moderators for this session, which is chaired by Emily Farnworth and advocate Vesselina Haralampieva. Emily Farnworth is the co-director at the Hughes Hall Centre for Climate Engagement at the University of Cambridge. She brings over 25 years of experience working with businesses, government, and non-profit organizations to support the transition to a low-carbon economy. She has previously served as the head of climate initiatives and is now a platform fellow at the World Economic Forum. Advocate Vesselina Haralampieva is a senior counsel at the European Bank for Reconstruction and Development in London. She specializes in energy regulation, environmental law, and sustainable finance. She leads the Energy and Climate Change Practice area of the Office of the General Counsel's Legal Transition Team. Vesselina is a member of the Working Group on Climate Change to the Law Society of England and Wales and is a frequent speaker on climate finance and climate law and governance. She holds law degrees from Harvard Law School and Sophia University. We're incredibly fortunate to have such distinguished chairs with us today, and it gives me great pleasure to hand over to them now.
Thank you so much, Keisha. Really appreciate the warm welcome and absolutely wonderful to be here today. In order to hand over to my colleague, Dr. Ron Zimmern, to provide opening remarks, just by way of introduction, Ron is a lifelong fellow at Hughes Hall, as well as being the chair of the Centre for Climate Engagement, which I am also co-director. So it's a warm welcome and really excited to hear from Ron to kick off the conversation today. Ron, over to you.
Thank you, Emily. So distinguished guests and colleagues, as you've heard, my name is Ron Zimmern, and it's a real privilege to be able to make a few introductory remarks for this session on law and governance. And I do so in my capacity as a fellow of Hughes Hall, which is one of the colleges of the University of Cambridge, and as chairman of its Centre for Climate Engagement, which I established in 2019 with Julie Baddeley as director. And Julie was joined by Emily Farnworth as co-director earlier this year, and Emily will be chairing, as you know, the panel for this session. Well, I'm retired now, but I'm a public health physician with a law degree. And my experience and expertise has been in bringing together at this university, academia, policymakers, and other actors in civil society in a different field, genomics and public policy, a field in which I've worked for 25 years. So in matters of climate and sustainability, my experience is much more limited, but I'm learning quite fast. So Julie Baddeley, Emily's co-director, is a highly experienced non-executive director who has worked across a variety of boards and who in 2017 became very much exercised by the lack of understanding of board members about the impact of climate change on their organizations and their failure to set policy and strategy for mitigating their CO2 emissions or for adapting to its consequences. And she asked me how she might do something about this. And it was in this context that Hughes Hall accepted our ideas for the establishment of a centre whose prime purpose was to bridge this gap and to empower the boards, and in particular, non-executive directors of corporate organizations to understand the importance of climate change and to act on that understanding. I was also very much aware of the climate law expertise at the college, led by Marcus Gehring as Director of Studies in Law, and of the expertise across the university as a whole in international climate, environmental, and sustainability law. In our first year, we were fortunate to have available to us time from Marie-Claire Cordonnier-Segar, who acted as a legal advisor to the centre, and from whom, and from Marcus, we learned a great deal about the COP process, the Paris Agreement, and many other matters related to climate law and governance. I cannot thank them enough for what they did to put us on this journey. And as a consequence, a second arm of our centre was established to provide academic leadership in domestic climate law that would be of interest and use to the corporate sector and others within the UK. So during this journey, it became quite clear to me that the study of academic domestic law, both private and public, and its application to climate change, biodiversity, sustainability was very underdeveloped. Even though domestic law will be needed in all jurisdictions to ensure that the terms of international agreements are met. I found that little thought had been given to the areas of domestic law that would, if you will forgive the vernacular, give the greatest bang for the buck. But consulting experts about this matter, I learned that company law, administrative law, tort law, and securities law were topics that might, if appropriately directed, pay significant dividends. But not just in those areas. There will also be significant potential for the application of criminal law, consumer law, competition law, land law, contract law, construction law, financial law, insurance law, public health law, just to name a few, to issues of climate, biodiversity, and sustainability. It is my sincere wish that the climate law community will give due attention to the need for greater expertise in these diverse areas of domestic law, and to establish mechanisms that will enable specialists in these areas to apply their expertise to issues of climate and sustainability, and also to build capacity in this increasingly important area of legal study. The Hughes Hall Centre will play its part by providing several postdoctorate opportunities in domestic law, both private and public, and by seeking to make the college a hub for such academic study. These positions are currently being advertised, and we encourage you to share them with your networks. The Centre now works very closely together with Cambridge Zero and with the Centre for Science and Policy, and in particular, the Cambridge Zero Policy Forum, which is jointly chaired by Dr. Emily Webster, Emily Farnworth, and Dr. Rob Doubleday. The Centre will also have increasing links with the Department of Land Economy, where academic studies in climate law and policy will be situated. So I conclude here. Thank you very much, and will pass you back to Emily Farnworth, who, as well as chairing the session, is our centre's co-director. Thank you.
Thank you so much, Ron, for that introduction. And, you know, it's incredible what's the sort of inspiration that you and Julie have found so far. And as you say, we're really looking forward to continuing to work across the university and the broader university networks around the world as we strengthen our understanding of climate law and governance. I'm now going to introduce our speakers, those who are going to be introducing their research and setting the tone for the conversation, and I will hand over then to Vessi to introduce her colleague from the EBRD. So in terms of our incredible lineup of speakers who are going to be talking about their research, firstly, we have Dr. Emily Webster from the University of Cambridge, who's going to be talking about UK company law. We have Danilo, Garrido, Alves from the University of Oxford, Tejas and Pedro Schilling from the University of Cambridge, who are going to talk to us about risk disclosure and net zero in the context of in terms of climate action tools that can be used. And we also have Adwoa Appiah, who is going to be speaking from the University of Waterloo, specifically looking at the Green Climate Fund and availability of finance to African banks. So Vessi, I'll hand over to you to introduce your colleague and to kick off the discussion. Thank you very much.
Thank you very much, Emily, and good morning, good afternoon to everyone. It's a real pleasure to be here. I just wanted to say that it's also a pleasure for me to represent the European Bank for Reconstruction and Development at today's event, together with my colleague, Gian Piero. And in addition to the commitment of EBRD to align its financial flows with the Paris Agreement. We also contribute substantially to efforts on the ground in emerging markets and developing countries to develop legal frameworks, to launch governance initiatives, including climate governance initiatives. And in that efforts, we hope to continue closer collaboration with the Climate Law and Governance Initiative and with the Climate Governance Initiative at the Hughes Centre. So it's a pleasure again to be here. I want to introduce now my colleague, Piero, who has more than 20 years of experience in providing advice on corporate governance to regulators, to boards, to executives, and other senior colleagues within the EBRD and to external clients. He is, at the moment, he leads the financial law unit at EBRD, and he focuses also on sustainable development. And his efforts and our work, of course, is very much directed to the emerging markets and developing economies. And with this, I would like to turn to our first panelist, to Dr. Emily Webster. And Emily, we look forward to hearing your presentation about your research focused on UK company law in the context of climate change. And if you could tell us a bit more about why did you choose this topic of research and how do you think this has been evolving over the last few years? It's been, as Dr. Ron Zimmern mentioned, under a lot of evolution. Over to you, Emily.
Thank you. Thanks so much for the introduction. So just wait for my slides to come up here. Wonderful, thank you. So as introduced, I'm going to be focusing on UK company law in the context of climate change today. So next slide. So why focus on companies? Well, there's a significant balancing act that needs to be undertaken, or that is undertaken, when governments seek to regulate companies. So on the one hand, companies are incredibly important actors for the global economy. They secure jobs, can improve standards of living, and often in many countries offer public services. So they're important social actors, and therefore this is borne in mind when governments are regulating. In the context of climate change in particular, as the Paris Agreement recognises, private actors and companies are really very important in order to implement the agreement in practice, so particularly regarding reducing greenhouse gas emissions. On the other hand, so we have companies as public goods, but we also have companies as the propagators of public bads. So many sectors cause considerable damage to the environment, so not just in climate change. But in regards to climate change, there are wide-ranging contributions. So not only directly with the result of the emission of greenhouse gases, but indirectly through land use changes, deforestation, and land degradation. So a variety of sectors are implicated in not only the contribution to climate change, but ecological harm more generally. Next slide, please. And law, as we've seen, as we can see, has been quite inadequate when trying to deal with these wider environmental problems. So staying with the UK, there are a variety of different environmental issues that these pictures demonstrate. But I'm just going to focus on two kind of current environmental catastrophes. So the first, if you're aware of UK environmental news at the moment, has been a massive problem with the discharge of untreated sewage into rivers and across coastlines. And this is from private companies that are giving a public service, so the provision of water and the treatment of waste. and who it was hoped that through privatization would actually invest in infrastructure, which hasn't actually happened, resulting in huge pollution of waterways. And there's a massive argument at the moment between the House of Commons and the House of Lords regarding whether law should intervene and the extent at which it should do so. But what's clear is that regulation has failed to prevent this environmental harm. The same with biodiversity loss. So in 2020, the Natural History Museum and Biodiversity Trends Explorer has said that the UK has only 53% of its biodiversity left, the most nature depleted of the G7. And this is a result of, among other things, land use change, agriculture, and construction. So it's a significant problem, but demonstrates that existing environmental regulation just isn't sufficient to deal with environmental problems or the environmental externalities of companies. Next slide, please. So why company law? So from my perspective, we really need to be addressing the environmental harm caused by companies through a variety of different regulatory regimes. So not just environmental law, but other areas and other mechanisms that are available. But at present, companies law and the regulation of companies just isn't sufficient to address this and to address climate change more generally. So we have directors' duties where directors have a duty to act in the way that would promote the success of the business for the benefit of the members as a whole. And they must have regard to the environment within this duty. But the only case law that I'm aware of that has, the case that has addressed this has really reasserted that actually the directors need to be concerned with the success of the business rather than the environment. So it takes a predominant position. We also have due diligence requirements. Environmental issues and climate change also aren't implicated directly within these duties so far. And more generally, there's just a lack of enforcement. So only certain enforcement mechanisms exist, and they're not really suited to addressing environmental law. So environmental problems, sorry. So companies law at the moment is really not adequate or set up to consider or to work towards alleviating environmental problems. We see more recently the introduction of mandatory climate-related financial risk disclosures for certain public companies, which will be extended across the whole economy, so to financial institutions, banks, insurance companies, for example. But this is really related to the disclosure, the identification and disclosure of financial, climate-related financial risks to companies. And it's reliant upon investors or other actors using pressure to try and get behavioural change to occur. It doesn't actually have any kind of practical consequences for most companies that are unwilling to change their behaviour. And next slide, please. So my argument is that we need to move towards a more ecologically responsive regulation. So we need regulation that is responsive to the ecological degradation that's occurring, often as a result of a direct result of corporate activity. And we need to understand that there are ecological limits that we need to live within and we need to act within. And this means that other areas of law, not just environmental law, need to be attendant to the ecological degradation that is caused by corporate activity and responsive to it in some way. And there may be early signs that this is occurring in the UK. So we see kind of changes to due diligence requirements. So in the UK, there may be introduced requirements for companies to undertake due diligence regarding deforestation in third states, so along their supply chains. Within climate risk disclosure, there's talk about introducing or requiring companies to produce net zero plans, and also talk about introducing nature-related information disclosures as well. And in the environmental bill, there's talk of introducing a requirement for biodiversity net gains for some infrastructure projects. Next slide, please. However, there's not a great deal of movement in this area. at the moment. So we see law and regulation that has really kind of facilitated or allowed this ecological crisis to occur. What we need is reform that introduces a more holistic approach. And when I say holistic, I really mean that there are areas of law that are all acting towards addressing environmental degradation, both directly and indirectly from corporate activity, but acts in a more coordinated manner. And we see some movement in the right direction, but at the moment it's not going nearly quickly enough or comprehensively enough. So thank you, and I look forward to any questions that you might have.
Thank you, Emily. Fantastic presentation, very topical, very interesting, and indeed we'll open for questions after all our panelists have had the opportunity to present their research. With this, you mentioned briefly the climate risk disclosure rules, and this is also part of the research the topic of our next panelist. So I would like to invite Advocate Danilo Garrido Alves, and he will be co-presenting with Advocate Tejas Rao. So please, the floor is yours.
Thank you very much, Vesselina, for that kind introduction, and good afternoon. My name is Tejas Rao, and I'm an Associate Fellow with the Center for International Sustainable Development Law and the Leverhulme Trust Research Assistant at the University of Cambridge. Together with my colleague Danilo Garrido Alves from the University of Oxford, we are pleased to be here and to present to you this research, which examines the various legal tools available to move commercial and financial institutions and the financial sector as a whole toward net zero. While our slides get ready, this research began just over a year ago with a survey and review of all the literature on corporate climate risk disclosure. As such, it is currently in the very early stages of research being conducted under the guidance of Professor Marie-Claire Cordonnier-Segur, and our aspiration is to develop it over the coming years into a project between the University of Oxford and the University of Cambridge, competitively funded by academic councils. We are hopeful that the ideas shared over here today and from this conference as a whole will assist us with this endeavor. While we wait for our slides to come on screen, we also need to understand why we are looking at this today and why it is important that we study this at this time. As our chairs echoed and the welcome addresses showed us this morning, there is a large volume and amount of capital that is involved, and more critically, that this capital is publicly traded. If I may have the next slide, please. What we can see over here is that there are over trillions of dollars that are available in bonds, equity, and managed by the banking system as a whole. But equally, where these are publicly traded, we can see a large number of both banks and financial institutions listed on stock exchanges. Can I have my next slide, please? Second, and the other reason why this is important to study is because there are efforts being made to make this finance more sustainable, and there is an increasing momentum in the sector itself, with commitments growing across multilateral development banks as well as financial institutions. It is critical, therefore, that we use legal tools creatively to ensure that these voluntary suggestions that come out of this research are made into obligations. If I may have my next slide, please. We use the phrase voluntarily here deliberately. The Financial Stability Board's-led TCFD has created a set of climate risk disclosure recommendations. And from within the boardroom, what we can see is that this forces an increasing alignment in decision-making with the Sustainable Development Goals, but equally creates conversation about climate risk. However, what we see as being problematic is that there is a varying implementation from country to country. We can see, however, that the scope is immense because the FCA in the UK has been particularly positive as a first mover. Next slide, please. The Cfrf case studies from October 2021 present two clear indications of the positivity of making these obligations and putting them into a framework that encourages disclosure taking place. We can first see the example of a bank which published an emerging climate change statement, which is a public set of positions and restrictions that are linked to high emissions and climate change, and additionally put forward a shareholder resolution to become a net zero bank by 2050 and commit to align all financing activities with the goals contained in the Paris Agreement. We can also see the example of a financial services company, which created a climate change working group to bring together all the key functions on climate change, and additionally appointed a head of responsibility who serves as the climate change coordinator. Next slide, please. An additional set of rules that can be used, or an additional set of tools rather, is in the form of outside counsel guidelines. We can see on the screen here 4 different ways in which banks and multilateral development banks engage with outside counsel. First is through the procurement process or through selection guidelines for where outside counsel should be selected. We also have the guidelines themselves that are issued to outside and external counsel. We have the letters of engagement, and we have service agreements. Next slide, please. What we see as being taken place is that the scope of how this can create impact is available through the inclusion of net zero language and obligations within any of these instruments. There are limited publicly available examples of best practices, but our research has shown that first, a US public bank has incorporated clauses that prevent the transfer of capital into outside counsel who engage with environmental issues in a negative manner, in a way that is not limited to the CER, CLA, the RCRA, the underground storage tanks, asbestos and lead-based paints, wetlands, endangered species, and the National Environment Policy Act. We also see that a financial services company has created guidelines that prevent engagement with firms that participate in environmental harm, explicitly mentioning that there is an obligation on law firms and outside counsel to ensure the environmental reduction of environmental impact. And furthermore, there is also a waste clause preventing the creation of additional waste. We also indicate that our research has shown that these are tailor-made for law firms, and there is no one-size-fits-all approach that is being taken. With this, I now pass it on to Danilo.
Thank you very much, Tejas. So this part of the research is informed by my doctoral research. And the main argument that I'm trying to make here is that in relation to multilateral development banks, there is nowadays a legal requirement for all projects to contribute to sustainable development, which could include net zero commitments as well under the environmental axis of sustainable development. I'm happy to explore this further in the Q&A, but in the interest of time, I will go directly to the topic of the accountability mechanisms, and mainly how they can be, how they can play a role in ensuring that this legal requirement is fulfilled. Can I have the next slide, please? I chose to explain two cases which are very illustrative of both how they can affect change in MDBs and also for the client corporations or client states that lend money from MDBs. But first, let's address what's the purpose of accountability mechanisms. They are to make the multilateral development banks more accountable towards individual and communities affected by the development projects, rather than the financial states or even the contracting states, which is another good way that this mechanism ensures that ESG in general can be addressed. The first example that I want to bring is a case of how MDB's own policies can be changed when deciding on funding and monitoring, which is the compliance role that accountability mechanisms take. This example is from the World Bank's IFC, especially the Tata Ultra Mega Project. And what happened in this case was that the accountability mechanism, it reviewed the compliance of the bank with the existing rules framework. And indeed, it found that the bank had adopted a minimalist interpretation of its own standards and recommended additional measures. What's striking of this case is that the bank did not comply with accountability mechanisms, which is one of the challenges. We need to strengthen these mechanisms because their role is essentially recommendatory nowadays. And what's especially important about this is that this case even made it to the U.S. Supreme Court, incurring costs, a great cost for the bank in expensive litigation, and taking a lot of time to address the issue. But unfortunately, this case was dismissed on procedural grounds, so we were unable to hear on the content. I'm happy to also address the other example for clients. As in the interest of time, I'm running out of time. But I would just like to stress that in the case of clients, these mechanisms, they only work in the specific project upon which the claim has been brought. So its potential impact in changing the behaviors of the bank itself are less present. And this is also often known as a dispute settlement role. In sum, this is a conclusion. The proposals that we're trying to make with this research is that accountability mechanisms need more strengthening. There is also a need for rule harmonization across different types of international organizations. And this is actually something that several banks are coming together to harmonize their environmental social policies, which could be very good for the effectiveness of accountability mechanisms, and also MDB cooperation broadly. Thank you very much, and apologies for overrunning.
Thank you so much, Danilo and Tejas, both very interesting presentations, very timely and on two interesting topics. So we hope to get some Q&As and we can explore this further. So with this, I would like to give the floor to Adwoa Appiah, who will be talking about accessibility of the Green Climate Fund to African banks for financing climate resilient projects in Africa. Adwoa, let us know, why did you choose this topic in particular? What are the main findings, and are there any solutions? Over to you.
Thank you very much, Vesselina. Good day, everyone. I'm delighted to deliver my presentation at this conference. I would like to take this opportunity to say thank you to colleagues in the banking industry in Africa whose perspectives and insights were very helpful in putting together this presentation, and also to the faculty in the University of Waterloo SEED for their continued support. So to answer your first question about why this topic, could you please go to the next slide? Thank you. The indicators of climate change in Africa include rising temperatures, rising sea level, coastal erosion, and extreme weather conditions such as droughts and floods. Next slide, please. The impacts of climate change in Africa include increased food insecurity, health impacts such as outbreak of diseases like malaria and yellow fever, and most importantly, the impact on our economy. The GDP of Africa is expected to decrease by about 2% to 12% with increased temperature. Next slide, please. This slide actually highlights the fact that 3 regions, which make up 69% of countries in Africa, will be significantly affected by this dip in GDP as a result of increased temperature. Next slide, please. The Green Climate Fund is therefore a welcome development for the continent of Africa because of its aim at helping developing countries to address climate change. The key characteristics of the GCF is its focus on country ownership through the direct access funding mechanism, its equal allocation of funding for adaptation and mitigation, and equal governance representation for both developed and developing countries. Funds are typically disbursed via 2 main modalities: direct access entities, which are national and regional entities, and international entities. Although the aspiration of the GCF is to promote country ownership, the data shows that about 77% of funding or projects are implemented by international entities. Next slide, please. An analysis of the Africa GCF portfolio indicates that although Africa currently has 77 out of the 190 projects of the GCF, 25% of these projects are implemented by direct access entities, and 31% of the projects in Africa are private sector oriented. Next slide, please. A further analysis of the private sector projects indicate that 24 private sector projects are approved for African states, and about 29% of these projects are implemented by direct access entities. Out of the direct access entities implementing private sector projects in Africa, 17% of these projects are implemented by banks. And a further analysis of the banks implementing these projects highlights that 4% of these projects are implemented by a commercial bank. And this commercial bank actually got approval for funding earlier this month. This scenario therefore highlights the great opportunity that African banks have in participating in the Green Climate Fund. Next slide, please. In order to set the context on the reasons behind the low participation for African banks in the GCF program as direct entities, I thought it necessary to highlight the reasons why more African banks, specifically commercial banks, should have access directly to the GCF funding mechanism. Some of these include the fact that commercial banks in Africa are key sources of financing for African states meeting their nationally determined contributions, which are the commitments made by countries on how they intend to address climate change in their countries. It's estimated that Africa needs about $3 trillion by 2030 to meet its NDCs. And therefore, we need all hands on deck, including private sector actors like commercial banks. Secondly, commercial banks participating as direct access entities will enhance their capacity to integrate climate finance into their banking operations, which is very vital. Thirdly, African banks should participate as direct entities because they have more entrenched interests and local knowledge on the ground, and so are able to, are more suitable to finance a low carbon and climate resilient development pathway for the continent. And finally, I believe they should have direct access because there are a number of benefits that they stand to gain, such as increased institutional capacity and future bargaining capacity to access international funds in the future. Next slide, please. Despite these benefits that have been highlighted, there are some key reasons accounting for the low participation of African commercial banks in the GCF program. Some of these reasons identified include the inadequate readiness support for Africa compared to its identified needs. A look at the recent report of the GCF on the readiness support program highlighted the fact that Africa submitted the largest number of readiness support requests, but received the lowest approval in both volume and value. And this point ties closely with the second one, because aspects of the readiness support funding and support and technical assistance is to increase awareness about the funding in the country. So because they are not able to have enough funds to do that, there's limited awareness and appreciation about climate financing and green climate funds amongst banks on the continent. The third key reason is the perceived relatively complex process for going through the entire GCF cycle. And this was actually highlighted by the independent evaluation report of the GCF on the simplified approval process done a few months ago. Another key reason for the low participation of African banks is the limited resourcing and capacity of these banks to meet the requirements of the GCF. For example, the accreditation process requires a number of policies, such as gender policies, redress mechanisms, which are not typically available by commercial banks and involve some commitment of resources and financing as well as governance to produce such documents. Finally, the limited policy direction by regulators, such as the central bank, account for the low participation. In Africa, there are just a handful of countries that have sustainable banking principles launched or enacted in the country to guide banks in this regard. And these countries include, but not limited to, Ghana, Kenya, South Africa. Next slide, please. In order to increase the uptake of African banks in the GCF funding mechanism and generally to increase their uptake in climate financing, which is very much necessary. A number of recommendations are proffered. These include the GCF should consider increasing the readiness support in terms of financial support to African states, especially private sector actors such as banks. The GCF should also consider designing a custom-made strategy for banks that tie in closely with their business model. This could, for example, include setting up a private sector facility board which can accelerate decision-making such as accreditation and funding approval. They could also consider increasing technical assistance to provide private sector DAEs such as African banks with the necessary skills required to effectively participate in the funding mechanism. This is because there are about a handful of banks that have been accredited, but unfortunately only one of these banks have an approved funding proposal, sorry. Another recommendation is for the central banks to set the right governance tone to attract participation by commercial banks through the formulation of appropriate policies. Additionally, there should be increased partnership to create awareness of the fund on the continent. This could happen through peer knowledge sharing, whereby the few banks that have been accredited could share best lessons and best practices with their counterparts who are yet to be accredited, telling them the benefits that they are gaining and what they stand to gain if they also get on board on the GCF funding mechanism. And there should also be increased engagement between international entities and local banks who have more knowledge and more skill and more capacity in this area. And finally, I believe there should be increased buy-in of senior management of commercial banks to enable climate financing and sustainability to be mainstreamed into the banking operations. I believe that if all these recommendations are carefully considered and implemented, we should see an uptake of African banks in the GCF funding mechanism and in climate financing in general, which will all contribute to Africa achieving its sustainable development agenda and a climate resilient development pathway. Thank you.
Fantastic, Adwoa. Thank you very much for your brilliant presentation. I will turn now to my colleague Piero, and I will ask him to provide his reflections on what are the key challenges of developing corporate governance frameworks and good corporate governance practices in emerging markets. And also considering the topic of the day and our recent work at the EBRD, what are the key challenges and opportunities for building and enhancing corporate climate governance? Over to you, Piero.
Thank you very much, Vessi, and thank you very much to the organizer for inviting me, and a warm hello to all the audience, wherever you are in the world. I think that the first possible issue that I would like to somehow to tackle is what is corporate governance and what corporate governance has to do with the discussion we are having here today. I think Emily somehow introduced the issue on the UK perspective, but I think it's important to know what we are talking about when we discuss about corporate governance. Essentially, corporate governance is not rocket science. I mean, essentially, corporate governance comes, and this is the simple and more clear definition I found, comes from the Cadbury Code, 1992 in UK, the system by which companies are directed and controls are implemented. So essentially, a set of check and balances that make the business life possible in corporation. And what does it have to do, I mean, with climate? Well, I think the answers on that comes from the evolution of corporate governance, from 1922, when the issue was essentially protection of minority shareholder, to the recent concept of ESG, so environmental, social, and governance together. And here the question is, what do they have in common, ESG? And my feeling and my strong conviction is that only if we are able to embed environmental and social consideration into the governance structure of the company, only in this case, this concept, this recommendation, the action of environmental and social can really be meaningful, can be really embedded within the company life. We see too many times that companies promote great voices about we defend the environment, we defend the social values, but then in practice very little is done. So the way I see the ESG, essentially the G is some sort of servant for the ES. What should we do in this respect? Of course, I mean, we always look in our work, we look at the practices. We look at the practices of companies, and we benchmark them with the best practices. And it's interesting to see that every time that there is a crisis, then the benchmark changes. This happened for the OECD principle on corporate governance. It happened to banks. Just one example. In 1998, there were the first corporate governance principle for banks adopted by the Basel Committee. And, you know, banking is the business of taking risk. And in 1998, nobody was thinking about the risk as an issue to put into the corporate governance principle for banks. Then, of course, the 2008 crisis came, and then everything now is based on risk. And the same is more or less as climate. I mean, nobody was considering, or very few people were considering climate as a big issue. Then in 2017, the TCFD, the Task Force for Climate-Related Disclosure, came out and proposed a number of recommendations. And if you look at the recommendations, they are essentially based on 4 pillars. And these are governance, strategy, risk management, and metrics and targets. And if you look at each of them, they are very, very strong link with governance. And what is the risk of tackling these recommendations without having the governance that as a substrate of that? Is that, I mean, this will remain tangential. I've seen cases of recommendation put forward by companies, for instance, on climate risk, for companies that have no risk management in place, or strategy for tackling climate for companies that have no strategy. So that everything, you know, it's a very glossy and nice papers that are edited, that are publicized, and then put on a shelf and left there. This is not the way that we would like to do business, and we would like to tackle the issue. So how do we do that? Well, essentially the work that we do in the EBRD, everything starts from looking at the practices. So with a review, we have a questionnaire, we go, we do due diligence, and we really try to identify what are the practices in place in the companies where we invest, in order to understand whether they are in line with what we consider to be best practices, for instance, TCFD. Once the analysis is done, then we propose remedial actions that needs to be put in place. But here again, where the governance comes into force. One of the issues that we see is that in many cases, companies do not have the basic structure in order to address these issues. And therefore, what we consider in our approach, in corporate climate approach, to be level 0 is when the company might be committed to do the certain actions, but they don't have yet the structure in place. And this is where we start, and we try to build together with the company a certain structure so that whatever recommendation is put in place then is then embedded within the business cycle of the company. If we look at TCFD, it's essentially basis, I mean, it's a disclosure framework. So there are a set of recommendations that require a company to disclose. But what is disclosure? First of all, we should always be careful in promoting disclosure, because disclosure is a cost. Putting forward information to the market is a cost that the company faces. We need to make sure that this cost is tailored with the audience. So sometimes it's not all important to build the disclosure or the disclosure channel, but it's equally important also to build the audience. I think, and this maybe addresses one of the questions that I saw in the chat, I think there are essentially three factors that make a project, a reform, successful. I would say in all aspects on which I worked, corporate governance included, and corporate climate governance included. The first is culture creation. You need to create a culture. You need to convince people that whatever is done is for a reason. There should be an understanding of what we are trying to achieve. And this is achieved through training, to media, to messages, and so forth. So this is the first. The second is pressure. And I think we all need to thank Greta for that and for the whole pressure that is putting. And pressure can come internally from the company through the various check and balance the company put in place. It can come from the regulator, especially for the banking sector, but it should come also from the citizens, for the media, for the NGOs. And the third is rewarding. While it is important to spot the companies that are the most polluted or the ones that are the worst performing, it's also important to identify the best, those that should shine. And in fact, when we're talking about corporate governance, it's never a matter of compliance. If you look at the legislation on corporate governance, it's very limited. And you see that in most of the countries where we work, it's what we lawyers called norma or law imperfecta. So there are provisions, but there are no sanctions, unless, of course, we're talking about financial markets. So for instance, companies are required in many jurisdictions to publish an annual report, but there is no sanctions if the annual report is not published. Most of the provisions are based on what is the approach is called comply or explain. So companies are required to comply with the recommendation. If they do not comply, they should explain why not. This part of the report is disclosed by the company. It's important that these reports are challenged by people. It's important that, especially for companies like state-owned enterprises, banks, where the number of stakeholders are many. This is the kind of dialogue that I think makes a thing changes. I'm not sure about hard regulation to start with, but engaging with the company in order to create the culture, to create the pressure, and to name and shine those that might be the best performing, I think might be a great avenue for improvement. My last point is that if you're interested about what is the situation of corporate governance in the EBRD region, with ranges from Czech Republic to Mongolia and from Belarus to Morocco, look at the www.ebrd.com/law. You will find an assessment of all our countries. Thank you very much.
Thank you very much for that overview. It's really interesting to hear from everyone, actually, and I'm just going to jump in before I hand back to Vessi with just a quick follow-up question and maybe just an observation and a comment after hearing all these incredible presentations. I mean, it seems to me that we have a real mixture of voluntary action, of kind of regulation that perhaps isn't really working, of sort of signals for more regulation to come, of policies around goals, of policies around kind of what needs to be in or what needs to be out of a particular a kind of trend, if you like. It's quite a confusing space of sort of, you know, what is already happening, what might happen next, and also this tension between whether or not it's enough to require corporations in particular to be able to self-disclose, and the point that was just raised now about, you know, whether if there's not enough scrutiny and if there's not enough consequence associated with poor reporting, then, you know, where does that get us? So my open question to all of you really is this sort of, you know, where do you see the kind of the critical policy shifts need to be, and how much hard regulation versus soft regulation would you like to see to really help accelerate the climate challenge? I don't know who wants to kind of jump in with an initial reaction to that question.
I'm happy to start with that one. So I think a lot of the points that have been made are hugely pertinent, and I think we're in this awful situation where we need action, we need adequate action, we need fast action. We haven't got time to now, because of the time that's been lost, we haven't got time to experiment. And usually when we're addressing new problems, we can experiment with governance mechanisms to see what works and what doesn't work. So it's a very difficult situation. And my feeling is that regulation is very necessary, but I'm qualifying that with saying that it has to be the right kind of regulation, because as I kind of mentioned, law can make things much, much worse. It can be ineffective it can make sure that other areas that perhaps aren't as popular, that maybe, you know, more adequate or maybe more sufficient mechanisms are overlooked. So I don't have an answer to that question yet, unfortunately. I don't know what the best mechanism is. I don't know whether we say, well, actually, the best thing to do, especially with huge multinational polluting companies, is to say, you know, mandate net zero plans. So taking kind of the Shell case in the Netherlands as a kind of exemplar, that we say, well, some of these multinational companies, the most polluting, the most environmental damaging, must have plans, must implement these plans, and that they're enforced. But it's not going to be the right solution for every state, and it's not going to be a solution for every sector. So I don't know is the honest answer to that situation. And this is why, you know, academic research in line working with people in practice is really important to try and kind of identify the best interventions.
Thank you, Emily. I see that Danilo has raised his hand. Would you like to come in on this point, Danilo?
Yes, please. Thank you very much, Vesselina. I think I will challenge that question, actually. So instead of seeing hard regulation, soft regulation as opposed, how can we try to harden soft regulation? And I think one example that I'm looking at my own research is how can the contracts that the multilateral banks are signing with both corporations and with states, how they implement the environmental or social policies that are seen as soft instruments, and how they can enforce that. And I think this is also the idea behind outside counsel engagement. So I think trying to be creative also in the mechanisms to try to enforce or to strengthen in a way that perhaps doesn't involve courts, but that can harden existing soft laws.
Thank you. And I think Tejas now wants to come in.
Yep, thank you very much. Just to add and build on from what Danilo said, I think one of the things that's become clear to us when we're looking at the kinds of regulations that have been successful or the kind of ambitions that have been successful is that there is a strong emphasis and a strong movement towards appreciating the value of transparency, both in terms of trying to get climate risk disclosure to take place and in terms of engaging with outside counsel. And if we it may be a concern, and I fully appreciate the concern of trying to address sectors independently and address different financial institutions in different ways. But I think building on from this idea of transparency and building regulations and ambitions from this starting block of transparency, which is not something that's very easy to get institutions to agree to, I sense that may be a successful path to take, and it is something that is yielding positive results within the industry already. So yeah, those are my 2 cents.
Great, thank you. And I'll turn to Piero for his insights on this question. Then we'll take a couple from the Q&A.
No, thank you. I think I agree on what was said, but the reflection I would like to, my 5 cents in this reflection is, let's consider what happened with the financial crisis. I mean, you have seen that this big mess with the subprime that happened in various parts of the world, and at the end, you know, the rules were there. The rules were absolutely there, but nobody actually was punished. In terms, yeah, big fines to banks, but at the end, even if there was criminal actions, nobody went to jail. So very few, at least, went to jail. So I think that in English there is this word that is called accountability, which is difficult to translate in other language. And I think this is what really we need. I mean, who is accountable? Who is accountable? I mean, if we want to have a legislation, I mean, let's first define who is accountable. And then let's try to understand whether the person is really accountable or not. This, I would say, the first. I would agree on enforcement. Enforcement is a very difficult issue, especially in emerging markets. And therefore, we need to find a way in order to make sure that whoever breaches the rules is at the end punished. And I think the third goes back on what I said, culture. there is still a lot of misunderstanding on how to tackle these issues, especially by regulators. And if the regulators, they don't understand it, that they will not be able to enforce. So one size does not fit all. And therefore, I would agree with Emily that we need to be careful in a hard law, just obliging everybody to do whatever actions, because I think corporations are different, and therefore they need to be treated accordingly in different ways.
Thank you, Piero. And Adwoa, I think it's you had your hand raised if you want to comment on this question.
Yes, thank you very much. I think I'll just like to add on to what my fellow panelists have also said, and maybe from the sub-Saharan African context, considering what I had mentioned in my presentation. I'm thinking that, first of all, they need to increase awareness. So if it shouldn't be hard law, it should be more like soft and voluntary, so that, for example, the banking associations in the respective countries, such as has been done in Ghana with the Banking Association working closely with the Environmental Protection Agency and the Central Bank, coming up with a sustainable banking guideline, will create awareness about these needs and how these banks can also contribute towards climate financing. So that's just what I wanted to add, that some collaboration or inclusive governance between the various actors will be very helpful. Thank you.
The test of the fire and voice alarm system has now been completed.
We have safely completed our test for fire alarm. So I see Emily has raised her hand, but I'll turn to you maybe with one of the questions from the audience. Ahmad Sukma has asked how we promote ESG in order to advance stronger laws and regulations, especially in developing countries. I think that it's interesting that if you he's opening up. We've been talking mainly about climate, but Emily, over to you if you can address it also from environmental, social, governance perspective. What's your views? Do you want to answer this question?
And I guess this kind of really links to what I was going to say. So I think one of the kind of issues with ESG is its kind of voluntary, its voluntary nature at the moment. And I think this kind of links back to the kind of soft law point that was raised by Danilo and Tejas. And I guess my concern is that often these norms are produced by the actors that they seek to govern, or with a great deal of influence by the actors that they seek to govern. And because of that, can tend to be weaker than you would perhaps like or need, especially when I'm considering multinational companies here rather than smaller companies. And so I think we have to be really, really careful about making sure that we choose approaches that are sufficiently stringent that they have the desired effect. And with ESG, I think this is, or ESG requirements, this is particularly important, that if we require these factors to be taken into account, that they are, it's done so in a way that has the desired impact, because unfortunately, and in a great deal of the private initiatives that promote kind of taking these factors into account are influenced by those that are, signing up to them, and the competition between different private initiatives that occurs in this space that can lead to kind of weakening. So that's my kind of my concern about soft law in this area.
Yeah, great. I also wanted to add that we don't necessarily need to think of a dichotomy of, the private sector action versus laws and regulations. And I think it's safe to say that one of the most successful private sector initiatives that are aligned with Paris Agreement and consistent with, with the broader objectives of the Paris Agreement were indeed initiated by the industry, by experts, and this is indeed the Task Force on Climate-Related Financial Disclosure. It started as a voluntary initiative, and relatively, I would say, fast. It's raised the number of supporters to now, I think, 1,500 of large companies, the robust framework, the recommendations turn from, as we discussed, voluntary to now mandatory approaches, and in a number of countries, including the UK. So this also is a good prompt to regulators to act, especially I think when there is pressure on the industry to perform and to disclose, which in this instance came because of external pressures, but also internal, as Piero mentioned. So of the risk of the risks created by climate change being actually business and corporate risks, financial risks. So I think that this is a very good question now about this soft hard law and the role of the private sector. And what we have seen also is quite a different approach in the emerging markets, of course, where maybe not always the private sector initiatives are leading to the extent that we have seen in the global north. I see the hand of Dr. Ron Zimmern is raised. So would you like to come in on this point?
Yes, I'd just like to sort of reflect on the issue that long before climate change was or sustainability was really appreciated by corporates, and even long before ESG, it's been known for decades that it is the companies, it is the firms that have a good corporate culture, that attend to their employees, that attend to their customers, that have a good relationship with the community, that do well, by which I mean they have their share prices go up, and that companies with a culture that is antithetical to that do badly. So I really do agree with Gian, Piero, Cigna that it is a culture that is the most important thing, and there's nothing new. I mean, to get the bottom line right, the concept of what the culture should attend to is not just your customers and your employees, you've got to attend to the environment as well.
Thank you. Absolutely. I'll move to, in the interest of time, we have two other questions from the audience, and please, to the ones who are listening to us, let us know if you have any other questions so we can raise them. I think the question about the board effectively. So this is a question from Professor Marcus Gehring. Should insurances refuse to insure companies if the question about climate change is not adequately addressed at the boardroom? How is I think this discussion being shaped over the last few years? I think there was a recent report also published on the duties of board directors in Delaware just yesterday or the day before. There are also some recent interesting research papers published in the UK. And of course, Emily's climate governance initiative is focusing on the role of the boards to raise the question of climate change and influence or kind of steer the companies into a net zero trajectory. So who would like to come in on this question? Okay.
Maybe I come in.
Okay.
And
great.
Yeah. First of all, just to finish. I mean, thank you very much, Ron, for backing my ideas. No, it's what I wanted also to mention is that, I mean, if talking about ESG, let's take for instance gender diversity on boards, and the role of UK. It's because I think it's when we're talking about ESG, it's also relevant to the discussion. Of course, in UK there are no hard rules in terms of gender diversity, but still companies perform really, really well. And I think that a lot needs to be paid to the role of media. I mean, there was a time, and I think it's still the time, where there was no week passing by that there was not at least a couple of articles in the Financial Times about gender diversity on board and how important it is. And this really contributed to make a culture in which then institutional investors, all market participants really bought in. And this was really what was making the difference. So it's not just a matter of laws, it's a matter really of making people understanding about the issues, whether the issue is important or not. This is on the first. Second, the question. First of all, DO insurance, it's a critical issue. I think it's very important. Unfortunately, in our region, it's very unlikely to be there. We have seen in many, many cases that there are no insurance companies that are offering DO insurance for board members. Should their insurance not to give this kind of insurance? Well, I think that I will not say that. I mean, I will not support that. They should maybe have a higher rate, higher premium. But because, I mean, at the end, you know, if the company does not address climate issues, it's more likely the company is going to make damages. And who pays for these damages? So, I mean, having an insurance, I think in some cases should be a must, especially for those companies that don't tackle climate issues. There may be a way in order to make them think that this is an issue they should discuss, is to have insurance that they don't insure them unless paying very high premium. I think this might be a good pressure for them in order to start considering issues, also to save money for insurance.
Thank you so much. And I just want to thank all of the speakers today. You've been incredible. You've given us lots of different insights, and I'm going to try very hard to provide a little bit of a summary. We were tasked with having a conversation today on a panel on advancing net zero in corporate, commercial and financial law and policy. And I think we've done a good job of kind of covering a very broad ground of touching on all of those particular issues. I think some of the kind of key takeaways from my perspective is this sort of tension that we have between needing to allow regulations to evolve, recognizing that it's not a one size fits all, that we need to kind of have this sort of balance of allowing soft and hard laws to evolve. And I particularly like this idea of sort of hardening soft regulations. And I guess the example Vessi gave of the task force on climate related financial disclosures and how that process evolved from a kind of a requirement to put forward a suggestion, which is now evolving into a mandatory requirement. I'm sure we're going to see many policy measures and increased voluntary action continuing. But I think one of the things for sure, and I think I would like to see increasing regulation from a perspective of being able to create a level playing field. We have a very, very finite, small group of corporate leaders currently driving what they would say is on track for a net zero or a science-based goal. And we need to make sure that the corporate world and also the investment community can get onto that same trajectory. And so I think whatever policies and soft and hard regulations that we put forward and suggest are going to have to be tools that can help us to get there as quickly as possible. And it seems from listening to all of you that there is going to be continued need for multiple levers that we need to pull, including this important question around culture. And maybe there's a question there around, you know, what kind of, you know, penalties are in place for organizations that don't have this sort of cultural push towards a global good. And I particularly liked this suggestion, and it's already happening as we're seeing in some countries and some jurisdictions, of a need for hardening up perhaps the requirement of net zero transition plans in a real sense. We've seen a voluntary movement for commitments. We're seeing a voluntary movement for more visibility and disclosure around transition plans. Maybe that's an area that we'll see firming up into the future to allow us not only to get the visibility of commitments, the visibility of what those plans are, but increasingly information about the progress that's being made. So again, I would just like to thank you all for speaking today, and in particular, like to thank my co-chair Vessi for working with us together on kind of discussing and facilitating the eminent speakers that we have. And just want to thank the organisers so much for giving us all the link to hop to the closing plenary and closing this session on time so that we can all do that. So thank you all so much for your time today, and thank you to all of those that have stayed with us to the end to listen to this panel. Look forward to chatting to you all soon.